Our next guest says to expect more trouble from Iran in 2012, and that could mean higher crude prices. Carl Larry, he is the president of Oil Outlooks and Opinions. He joins us now. Carl, a pleasure. Thanks so much for coming in. So why is Iran doing this? Why are they saber rattling around the Strait of Hormuz?
Well, I think, they're probably feeling a little bit left out right now. They are governing OPEC right now, but they're not getting the attention they want to. And with oil prices well over $100 and everybody trying to get their economy going back around, they really think they have an upper hand here.
But $100 a barrel, isn't that good for the members of OPEC? Aren't they earning enough money by selling it at 100?
I think they are, but I think that they know that there's limited supply, that spare capacity that OPEC has. OPEC's pushing out about 30 million barrels a day that we know of. That's not including cheating. So, supply's tight. So any kind of disruption, as we saw with Libya earlier this year, could really send the market, skyrocketing.
All right. Do you think that investors are already positioned to take advantage of what could potentially be higher prices? We always talk about this idea of, buying futures contracts for delivery in later months.
Sure. I think that the futures prices, I don't think anybody's really pricing this in yet. A lot of people are thinking that any kind of conflict in Iran would probably be a good $5, but I think it probably would be more along the lines of 10 to even more going forward. As far as other stocks go, we have to watch the refinery stocks. There's, margins have been really tight, and credit's been a big issue. We've seen that happen recently with the Petroplus in Europe.
I'm glad you mentioned refineries, because I want to get your thoughts on gasoline prices, particularly on the East Coast of the United States versus what has always been traditionally the higher market, the West Coast. That's changing.
Oh, absolutely. And it's kind of funny because the West Coast has higher prices because of taxes and EPA restrictions. The East Coast, conversely, is because we're seeing a lot of refinery shutdowns. But again, it comes down to high prices of crude oil, limited credit available for a lot of these refiners, and just not a lot of demand to kind of meet any kind of, putting any kind of money out there to kind of bring more crude in.
All right. So does this mean that we're going to see higher gasoline prices in the East Coast, and we're going to see exports of refined products from the United States?
As long as we keep seeing this grow, the oil prices grow, we're going to see higher gasoline prices. Now, the export's a new thing to America, but that's growing also. As I just mentioned, with Petroplus closing in Europe, or on the brink of closing, we're going to start pushing out more exports out here, and hopefully that'll make more money for refiners.
Well, does this mean that, for example, pipelines that are going to bring oil from the oil tar sands of Canada down to the refining capacity in the Gulf of Mexico, are they going to be a hot topic in 2012?
They are, and as we know right now, the Keystone pipeline that they're trying to open up and get that more oil down here.
Explain what that is for people that may not know about.
Well, the
Keystone XL.
The Keystone XL is an additional pipeline to bring more crude in from Canada down into the U.S. But right now, it's a big hot topic because not a lot of environmentalists want that to go through the U.S. And that's a problem. We've seen so many pipeline leaks in the past few years. Nobody really wants to move forward on that. But I think it's inevitable because we're going to need that oil.
And President Obama has said that there's not going to be a definitive decision about that Keystone XL project until after the November election.
That's right. And that's the issue here. A lot of people are thinking that the reversal, we see where there's going to be a reversal of a pipeline going from Cushing down to the Gulf Coast, bringing a lot more oil down into the refineries down there, which is a good thing. The problem is we don't have that much crude available to come into Canada or to come into Cushing to bring it down to the Gulf. It's going to cause higher oil prices, and we're going to see that reflected in the refining process.
Well, Carl, there's been a discrepancy in the price of Brent crude. That's typically the oil that is priced in Europe coming from the North Sea versus the price of oil that is priced West Texas Intermediate from Cushing, Oklahoma. Is that discrepancy going to narrow in 2012?
Pimm, I'm going to say it here right now. While 2011 is just on the brink of going over in 2012, I think, and what we think over at my research firm, is that that's going to flip back over. We're going to see WTI as the premium crude again, the benchmark for the world, and possibly take over Brent by maybe $2, $3. You have to think about Europe going downhill right now. The economy's over there in a slump. And like I said, going back again to the Petroplus story, that's going to be a lot of refineries without using a lot of crude over there.
We're going to have to pay attention to that. Thank you very much. Carl Larry joining us from Oil Outlooks and Opinions, giving us his outlook for World of Crude.